called a client, had to get their approval. And I say, hey, that thing that's doing really well in your account, I want you to own less of that. And this thing that's just really not doing well, I want you to own more of that. They'd be like, are you crazy, Erik? A $300 stock is not more expensive than a $100 stock. My son plays baseball, so I always use this example. His coach spreads the defense around the field. If there's 3 straight hits to shortstop, the coaches are going to go, wow, there's an obvious trend there. Any idiot knows that. Let's move everybody right around where the ball is obviously going. People try to do this in investment. I don't, because it could get hit to right field. We don't need share prices to go up to create return. We're selling options to create income. We're not buying for speculation. People like dividends because it's like a rent check from a piece of real estate. And they do tend to be less volatile. Invest, whether the market's up or down, have some dividend income. Our option income strategy takes that up to a much higher level.
Investors, welcome back to another go-round of Masters of the Market this week. I'm excited to have on with me Erik Thompson. He is a portfolio manager over at Peerless ETFs, joining us here on Masters of the Market. So first and foremost, Erik, welcome to the show. I want to pass the first question right over to you here and ask you about your story and how exactly you got to Peerless ETFs.
Sure. Thanks a lot for having me, Ari. And it's great to meet you. And, I watched some of your videos and it really resonates with my investing philosophy. So my story, I'm out of Columbus, Ohio. My dad was a professor at Ohio State University. So I've been Midwest my whole life. I got my undergrad from Miami of Ohio, a university just north of Cincinnati. Met my wife there. We've been married 25 years. We got 2 boys. I've been a retail financial advisor my whole career. Okay, so the ETF is relatively new. I'm 49 years old. I've been doing this about 25 years. Started with Edward Jones. I had no, rich uncles or friends to move their accounts to me. I kind of had to build it from scratch. Fortunately, those days were short and I got up to speed pretty quick. Spent most of my career at Wells Fargo, and then about 5 years ago, started my own fee-only RIA, Peerless Wealth. And then about 5 months ago, we launched our own ETF. So we have a separate division of Peerless Wealth called Peerless ETFs. That, and I have my partner Rob, who's not on this call, but he was very instrumental in helping me design the product. And it's our only fund. It's a very niche fund. It's not designed to be for an entire portfolio. It's kind of maybe a 10 or 20% type of position that behaves well in certain type of environments that we may find ourselves in.
I want to zoom out just a little bit here and even go back as far as talking about your interest in finance. Like where did that spark originate from? Did you always know you were going to go down the financial path when you were a kid in college?
What became clear ever since I waited tables in high school and had a paper out as a teenager. Then in college, I wound up running a house painting business in the summer and had, 20 or 30 employees. We painted, over 100 homes each summer for a couple summers in a row. Entrepreneurialism was something that really got me going. But I also liked finance and I liked markets. So I wasn't quite sure what I wanted to do with that when I graduated. And about the only reasonable job offer I got was at a bank in Detroit, salaried position. I was kind of a junior underwriter of commercial loans. It was really boring. And I remember after the first year, I had my, formal review. I got the same 4% raise that everybody else got. And it was at that point that I'm like, this isn't for me. I don't want a ceiling. So my mom actually knew a advisor with Edward Jones and got me acquainted with him. I made it through their interview process, moved back to Columbus, and started, building my client base.
I want to ask you this and jump right into the investment talk here and just ask you kind of where the best place to start is. I mean, as you were an advisor and you're always talking about what's best for the retail investors, all of us, where do you recommend we start?
I use a phrase, done is better than perfect, quite a bit, because I think people can get too fixated on details of the best and then they don't do anything because they don't know. And so I'm not alone in saying this, but if you started from scratch, buy SPY, buy an S&P 500 index fund, dollar cost average, take advantage of your company's 401k, live below your means. I mean, this is nothing new. Try not to speculate because not initially. Build a base, because what happens when you hear a hot stock tip online or from a neighbor and then it doesn't work out and then you have this thing in your head that it's rigged against me and this is bullshit. And no, you just just messed up, right? And you got to diversify. I finally started making pretty good money when I was, late 20s, early 30s. And I saved probably 30%, maybe more, always lived below my means. And I plowed it into broad-based ETFs. I have a handful of blue chip stocks that I've owned for literally 1 or 2 decades, but I don't do a lot of speculation. Sure, I have occasionally, with a very small part of my money. The pain of loss is twice the satisfaction of gain. And when you lose 50%, even if you make 50% the next year, you're not back to even. You're only halfway back. If you do the math in your head, you need 100% to get back. So I try to avoid the big losses. And as an advisor, I've been trained to keep my emotion out of investing. I think one of the biggest things people getting started, especially with all this social media stuff, avoid fear and greed. Greed, our emotion of greed will tempt us into, buying the latest crypto thing, right? And our emotions of fear will potentially persuade us to sell everything before the election because we're all going to go to hell no matter who wins. Like, I've seen this stuff, right? It's all on, and I've lived through it. And sure, you get bumps in the road, but owning slices of America, using kind of a line from Warren Buffett, is a pretty good way to invest over the long run. So start basic. Start with an index fund. If you want to buy some blue chips to keep you engaged, I don't think there's a lot of value that professional money managers and as well as amateurs. I know it's fun to pick individual stocks, but I think that large cap US market is very efficient. When you learn about the earnings report, Goldman Sachs is learning about the earnings report. It's very hard to get an edge. You might for a couple of years, but you go a 5 or 10 year period, even the best large cap managers, they might outperform the S&P, but just by a bit. And most of them underperform. So there's nothing wrong with just owning the index. I've seen your videos and you know what you're talking about, but kind of just set your expectations that I think the individual stocks really helps from an understanding and engagement standpoint. But if you truly diversify like you should, and you own at least a dozen names in different industries, you're probably not going to do a ton better, than the index. The only way you could is if you just own a couple of names and then you have a ton of risk.
Let me ask you this, because when it comes to fear and greed, which I really like what you shared, and I share the same sentiment. I really think a lot of investors, especially the retail investors, we're gunning off of fear and greed, and we want, what I always say, to get rich by Tuesday, and that's a fantasy. For the most part, unless you get that one-off home run that comes up every now and like once in a blue moon.
Yeah.
Erik, how do we train ourselves to be, steady on that buy trigger finger, or to kind of be a little bit more emotionless in investing?
Yeah. I try to think of, when you buy a stock, don't say stock, say business. Just little things like this. I owned the corner dry cleaner, and it had steady profits and steady earnings and a little bit of growth. Am I going to sell that because I'm worried about the election? Now, it's harder to sell. I can't do it on my computer, right? I got to get a broker. It's a lot more complicated as a private business. But just because it's publicly traded and the technology allows us to trade shares extremely efficiently, we don't have to. You can just think about it as a business.
Why do you think most of us aren't thinking of it as a business? Like it's said, Warren Buffett talks about this all the time. Plenty of investors out there talk about it. I'm sure you've advised clients in this direction. What is it with the retail investors, or just the investors in general, that make us so jumpy?
I honestly think it's daily pricing. It's minute by minute pricing. Like, if you've heard of the asset class private equity, right? A lot of institutions, and it's moving down to the retail world. There's vehicles you can do that now. But with private equity, most of the time, depending on the research, does a little bit better than like the S&P. And I think one of the reasons for that is most private equity vehicles, they lock your money up 5, 6, 7 years. And it's not valued every day, because you're not going to go appraise the corner dry cleaner, right? You might do it once a year or once a quarter. And so the fact that investors are, and I think with real estate, people think of it this way too, but they don't with stocks. If you think of it more like a rental property or a privately held business, look more at the earnings and the dividends. That'll in most cases be more consistent than the share price, because that share price bounces around for a lot of stupid reasons every day, as we know. So I think it is. It's the cool charts and graphs, and we can buy and sell, and we can do it for free. And it's kind of that gamification that I think it's great. If you need money, you can sell and pay your credit card off or whatever. That the liquidity is great, but it's a blessing and a curse, because I think it hinders people thinking about it as a business.
Now, you also shared just at the beginning of this interview, right? You've always been more of a saver. And before I get into the really depths of this stock talk, what I want to talk about just briefly here is saving before you invest, or actually getting the money to invest. Where are we going wrong as retail investors? Because I see this a lot in the comments. Hey, I don't have the money to buy, $1,000 worth of stocks. I don't have the money to buy, right? So we obviously know we're falling short somewhere. Where's this mentality coming from, and how do we plug the hole in the boat?
Well, it starts with budgeting and your income, right? I always tried to get my income as high as possible. Now, some career paths won't let you do that, right? If you're a teacher or a fireman, there's going to be some sort of cap on that, and then you're going to have to look at your expenses and cut those. But as a younger person, 20s and even 30s, if you can get that income higher, that solves a lot of problems. And then you just have to find the money and pay yourself and set up, again, 401k if your company has one and gives you matching. I always tell my clients, I'm a nice guy, but I'm not going to match your contributions to your investment account. But if your employer does, you have to do that. And that's easy. It's out of your paycheck. But don't put everything in retirement accounts, because then if you have an emergency before 59 and a half, you pay penalties and probably taxes. So, that's kind of the long-term bucket. Then you just start a regular brokerage account, whether it's at Schwab or Fidelity or whatever. They're all about the same. And you can buy, and here's ETFs versus mutual funds. One of the disadvantages of ETFs is you can't put like $500 a month in an ETF because the share price is moving around. You can't. You can put $500 a month in a mutual fund. Just get a monthly automatic contribution started and invest, whether the market's up or down, dollar cost average. I got in the business in late 99. We had 3 negative years for the S&P 500. What wasn't down during those 3 years was small cap value, real estate investment trusts, emerging markets. And people forget about those areas. And they have some very nice diversification properties that got my clients through that period. The other thing that gets you through the negative period is to dollar cost average, because then you're buying constantly and you're buying down at the lows, and look at the shares you're building, because then when it rebounds, you would have bought some lows. So you just got to find the money and get started, and don't, you can look at it every day, just don't mess with it.
Now, you also shared going down the ETF route or the mutual fund route. I mean, it's a safe bet. Now, a lot of investors love to jump the gun, get into individual stocks, but is your strongest recommendation for all of us to start with ETFs, at least for a foundation, or how do you recommend someone approaches the market?
That is my advice. Getting started, if you were getting started in rental properties, it's impossible. Well, not impossible, because you could buy a REIT, but you're probably just going to start with one property. But then if that doesn't work very well, all your eggs are in one basket. But you kind of have to do that with real estate, because it's too expensive to buy 10 at a time. With stocks, we can buy 10 at a time, or even 500 at a time, by just dollar cost averaging into a broad basket. I'm okay with individual stocks. I think you should know what you own, kind of like Kramer, right? Do some homework, know what you own, listen, follow someone like yourself that knows these companies, and you have a framework for why are we getting in, why are we trimming back. I think that helps investors be engaged, because sometimes with individual stocks, the great thing about it is if somebody owns McDonald's, they are less apt to sell it in a downturn, because they're like, McDonald's, I still see the drive-through line is around the block. I just spent $10 on there when I used to spend $5. It's fine. Right. And whereas sometimes, like a mutual fund, you don't have that story. So sometimes that's a little easier to maybe not think about it correctly. So I do like individual stocks from that point. Personally, I probably have maybe a third, maybe 50% in individual stocks. And I bought shares of these some of these 10 and 20 years ago. And I'll tell you, I own maybe 8 or 10. I have not sold them. I haven't sold anything substantial for years. I've trimmed back here and there.
Buy and hold.
I'm buy and hold because as you'll hear in a second, these companies, you don't really have to, they're not going to go under. Berkshire Hathaway, Google, Apple, John Deere, American Express, Microsoft, Blackstone, Accenture, that's 90% of it right there. And then the rest is like S&P 500. I like the dividend-based ETFs. And then I own a REIT fund from Cohen & Steers, Steers Realty Fund. They're like the top 10% consistently. Real estate's one of those sectors where I do think a good active manager makes sense, and they've done a phenomenal job. And then I own some small cap funds. I own the Schwab Fundamental Small Cap Index. It's kind of a profitability valuation index, not a cap weighted, but they overweight companies that have a little better fundamentals. And I own some international emerging markets. And if you look at international small cap and REITs, and you look backward 3 to 5 years, you're gonna be like, Erik, why do you own those? Just own the S&P. Own NVIDIA, right? But I've been doing this long enough to where these things change really fast and things rotate. And those 3 down years from 2000 through 2002, those areas helped out a lot. And the valuation, the PE ratio of the small cap index right now is like 14. The PE ratio of the S&P 500 is like 24. So you're getting a lot more value and they're cheaper, and ultimately valuation matters. And I'll talk about that a little bit more later. But
let me ask you this. Let's say someone builds a strong foundation with the S&P. They start, they just continue to dollar cost average. How do we know when exactly it's time to build upon that foundation with individual stocks? Is there a right time to do that?
I don't know, probably case specific. I mean, maybe for someone starting, it's I want to get S&P to 10 grand, right? And then I want to put my next $1,000 in some stocks. But just the basic rules there. The sector is probably responsible for half of your success, the sector versus the stock. So generally, if Microsoft's moving up, all of tech stocks are moving up. So own at least a half dozen companies. Not going to call them stocks, remember. Got to call them companies. Own a half dozen businesses and start with what makes sense to you. There's one more company that I own that I didn't mention because probably none of you have heard about it. It's called Diamond Hill. They are a mutual fund company. You can buy their mutual funds, and they have good performance. I know the manager's the owner. I know it well, and they have a very simple business model. They charge a fee on assets, very similar to my firm. It's very kind of repeatable, consistent. It's very easy to understand the valuation. They pay a dividend. So I think it helps maybe to own companies that you understand. You'll have more confidence that way. But, own a financial, own a tech, own a consumer discretionary or retailer. That's the basics.
And when it comes to picking stocks, at least for yourself, I mean, you have a nice list of gems, I'd like to say.
Yeah.
That go very well hand in hand with, a lot of the stocks I talk about on the channel. How do you come around to picking those stocks?
Well, the place I start, and this also, when I have clients that maybe transfer money to me and they have some individual names and we're kind of maybe trying to decide whether to keep some or sell some, I set up almost all my client accounts through Schwab, so I use their research. They actually have a pretty good track record. They have an A through D, A, B, C, and D rating. And, A's obviously, that's their buy list, and you can kind of go down the line, but they've been rating them that way for like 25 years. And I looked into it, and what they did is they did an analysis of the performance, average annual performance of the stocks that they A-rated versus the stocks that they B-rated, right? And the A-rateds had I'm going to guess, but like a 15%, annualized. The B-rateds were like 13, the C-rated's 9, the D-rated 7. Like, it was very consistent. It doesn't mean that, you're going to get everyone right, but as a group, that resonated with me. And then I like Seeking Alpha. I go on there and I like to see what their analysts are saying because I feel like they have a lot of good smart people that are not like with big Wall Street firms that are kind of thinking in their own path. But usually it's something I read, maybe it's an article on Barron's or something like that. I'm like, that does sound pretty interesting. And then I go to those other sources, and then I'm like, do I have a financial? No, I don't. Okay, Blackstone looks pretty good. And you got to be prepared to buy more of it when it drops lower.
Can we train ourselves on that? I mean, a lot of people see the market dip, and that's the last thing they want to do, although we all know that is the best thing you could possibly do.
You just gotta have intestinal fortitude and keep your emotions steady, and go back and look at the reasons why you bought it. Look at the historical earnings and the dividends, and it's likely, now maybe they had a little bit of a poor earnings report, but it's probably just maybe some overall market jitters, that's causing it to drop. But I will say this: we're at a period right now of very high valuations. We're in the top decile, maybe the top 5% of when you look at the PE valuation of the S&P and you plot them all. There's very seldom does it get above 25. Very seldom does it get above 23. I think we're like 24 right now. And a lot of that's driven by the Mag 7, those top tech names. If you pull those out, the S&P is about 18 times earnings. The historical average is like 16 or 17. One of the things I tell clients, especially when we're talking about individual stocks, a $300 stock is not more expensive than a $100 stock. Not the way I look at it. It costs you more to buy 100 shares, but you can buy one share, commission free. So it doesn't, forget about the price per share. You got to look at the ratio, price over earnings. When you buy a rental property, are you just going to look at the price of the property, or are you going to look at how much rent it makes? You're going to look at the rent, right? And there's going to be a ratio there. It's called cap rate in real estate. Stocks are the PE ratio is the inverse of the cap rate, and some of these tech stocks are pretty steep. Now they're growing and they're behemoths and they're not going away anytime soon. So there's an argument to be made. But last 10 years of the S&P probably won't repeat itself. When the analysis that we've done, and Goldman Sachs just put this research out a couple days ago, their forecast of the next 10 years S&P return is an average of 3% a year. When you see these lost decades, when I came in the business in 99, after the bank's collapse in early 09, that 10-year stretch, I had clients that had very little profit there because we went from a high, climbed up, then went down to another low. What will get you through those is a couple of things. Number one, don't rely entirely on capital appreciation. Have some dividend income. Our option income strategy takes that up to a much higher level and get a lot of income from it. And dollar cost average. And own some areas other than the S&P. Own the small cap value, own the REITs, own some emerging markets. Maybe 50% of your portfolio is S&P. Maybe 20% is some good blue chip stocks that you like. And then you have 10% each in just ETFs that track REITs, emerging markets, and small cap.
Let me get your honest take on dividend stocks. I mean, I got an entire dividend investing community, a lot of passive income lovers out there. Yeah. And of course, they're great hedges against market volatility. But aside from that, I mean, should we be entirely focused on dividend stocks? There's some people out there who've got, portfolios that are solely dividend stocks and they're in their early 20s. Is this, maybe an investment strategy for the elder investor? What's your take on just dividend investing?
Great question. It's not just an investment strategy for the elder. That's a myth. People like dividends because it's like a rent check from a piece of real estate, and it makes a lot of sense to most people, and they do tend to be less volatile. 2022, the S&P 500 dropped about 20%. The div stocks were down, 8%, like depending on what index you own, the SCHD or SDY. 2008, when S&P dropped 38%, the div stocks were down like 20%. So they are less volatile. Two pitfalls. Number one, don't just seek high yielders. There's companies that pay 5, 6, 7% yield. But then you're going to wind up with like AT&T and these names that are like not growing. And that will probably be the extent of your return is that dividend. And it probably means they're paying most of their earnings out as a dividend, which leaves them susceptible, if they stumble, to have to cut their dividend. Markets hate that, and that it'll sell off if there's a dividend cut. So don't just seek high yielders, growth of dividend. If you look at the research, Ari, I'm sure you've seen this, it is, over the last 20, 25 years, and I have an illustration of this somewhere, companies that pay low but growing dividends, the total return, dividends plus capital gains, and that's really what we should care about, the total return is slightly better than the S&P. The companies that start with very high dividends and don't grow, it's the other way around. They're lower than the S&P. The other so don't just go off high yield. And the other pitfall is if all you do is own dividend names, you probably won't own any tech, and you got to own some tech. I know there's some tech companies that pay. I mean, Google and Apple pay a little bit of a dividend, but it's minuscule. If you're one of these guys that just wants 5%ers, you're not going to own any tech. You want total return, but dividends, growing dividends, are a great place to start for that. And you might not own small caps either, because most small caps don't pay dividends.
There's a huge, community out there. I'm sure you've heard of it. FIRE, Financial Independence, Retire Early. There's, other income earners out there who are solely going and gunning for passive income to live off of. I'm curious to know, from your standpoint, is this more of a pipe dream for us to be able to secure that, live off your dividends?
No. It's not, but it takes a lot of capital, right? $1 million in a group of 4% yielders is only $40,000 a year. But doing that, that'll grow, and you're going to keep up with inflation, and you'll grow your share price too. Like putting $1 million in, you've mentioned it, like the SCHD dividend ETF, like that's a very simple, and it's going to work, but I don't think it'll work quite as well. If you put some of these other areas in it, a little bit of tech, a little bit of small cap, you can own real estate, or you can use options like we do, and you can create income from tech stocks that don't pay it by selling covered calls.
Let's talk about Peerless Wealth, here in the ETFs you got, and go very specific with what you guys are doing over there. Because it is a great way to complement a portfolio, and I think you guys are right on the target for us.
Thank you. This is it's a very niche fund. It's called the Peerless Option Income Wheel. Symbols WEEL, so easy to remember. It's traded on the New York Stock Exchange. What is an option wheel? Well, we didn't invent the term. It is a strategy that if you Google it, you'll see a lot of YouTubers and home gamers that are doing this. Now you can run it different ways. You can run it very aggressively. You can do it on individual stocks. We don't. We do it on sector ETFs. So we essentially divide the S&P out into its various sectors. Banks, which would be like KRE index. We use Qs, which is mostly tech. We have the REIT index in there. We have energy, XLE, and OIH. We use the gold miners for materials. And what's great about the liquidity and the popularity of options these days is a lot of these are trading weekly options where they used to do monthlies. And so we actually do a weekly overlay against these. And what that means is most people know what a covered call is. That's kind of your most basic strategy. We start at what I'll call the top of the wheel. Now, if you go to our website, peerlessetfs.com, there's a video on it, there's an illustration on this, because it does get a little technical for those that may not understand options. But it starts with a cash secured put. And and each one of these sector ETFs is its own wheel. Okay, so I'll pick an example. OIH, which is the oil service ETF, owns companies like Schlumberger and Halliburton. And let's say it's $300 a share. Let's say I want to buy it cheaper. Now, Warren Buffett has used cash secured puts to accumulate positions in names. He's a value guy. He likes to buy cheap. So what you can do is you can sell what's called an out-of-the-money put on OIH. So we might do the 285 strike price, and that's a week. So and we collect a premium for that. Someone's paying us for that because the other person is protected if it goes 285 or lower. We're basically selling to people that are speculating on the other side of the trade. We're selling options to create income. We're not buying for speculation. So this is a more income conservative strategy. So if it doesn't hit 285, we keep our dollar premium or whatever it is. And if we annualize that premium, we usually get somewhere to 10 to 20%, usually around 15% in annualized option premium. Like if OIH just never drops more than 14 points, and it will, but let's just say it never drops. We just keep the premium, we rinse and repeat every week, right? We do that on all the sectors. And we might get mid-teens return there, and then since it's cash secured, we have the cash secured in treasuries, which we're getting about another 4% on, in addition to that, 15% or so. So that's now we won't make much more than that. We're not if OIA skyrockets, we don't make anything more than that. That's the downside of this strategy. You do not experience the rallies. You just get income. Now, if and when OIH drops, let's say it finishes a week at 280, we got to buy it at 285. We're not too upset about that because we just bought it 15 points lower, but we're down $5 coming in Monday. So then it's 280. Then we sell a call against the share. So now it becomes a covered call position. And when it's a covered call position, you own the stock long, you sell a call. We will generally put our strike at the same price we got it assigned to us. In my example, it would be 285. We're going to get more premium for that. We might get $1.50 for that. So we get put premium, interest income on our treasuries, call income, so triple income. And then the reason we use ETFs is because OIH could keep dropping. There's no protection on it. We own it. We don't want the single stock risk because with this strategy, we're more or less capped on our upside. In a typical, if you own 10 stocks long, if you get one that just, loses 70%, let's say, you might have one that makes 70%, right? And it offsets. That is not this strategy. We're kind of going to be capped, right? So we have to avoid the big drops because we don't have another side of it to offset. So that's why we don't use individual stocks, because ETFs are going to eventually come back because it's broad based. You're not going to get, some nightmare stock story like Walgreens that was $90 a share 2 years ago and is now 20. So, and then eventually it'll come back. It'll hit 285, and it'll get called away. Now we're back at the top of the wheel in cash, and we just write another out of the money put, and we just keep doing that. So we don't need share prices to go up to create return. Flat markets, range-bound markets, slightly up, slightly down, it could be the very best thing in your portfolio because nothing else is doing anything. Our yield is like 11.5 right now. We might be able to get that a little higher because we just paid our first dividend. It's a quarterly dividend. This is a strategy. It's going to underperform in a strong bull market. We ran it in a hedge fund for almost 3 years now. In 2022, it was down 10% and the market was down 20%. Last year, I think it was up 22%. The market was up 25%. And this year, it's up like 16%. So it'll do well in a bull, but we're eventually going to be capped out on
Sure.
The dynamics of put writing and call writing. But in a lost decade, that's why I own it. PEs are high. My son plays baseball, so I always use this example. His coach spreads the defense around the field. If there's 3 straight hits to shortstop, the coaches are going to go, wow, there's an obvious trend there. Any idiot knows that. Let's move everybody right around where the ball is obviously going. People try to do this in investments, right? They see a trend and they try to latch onto it. I don't. The strategy doesn't because it could get hit to right field. So the point on these option income strategies is to hedge against a lost decade, a flat market. We seek to get better returns than like treasury bills, hopefully closer to equity-like returns. But it depends on that environment we're in. And we don't know what environment we're going to get in. So.
Well, let me ask you this, and it may be a silly question, right? But when something sounds too good to be true, right, it usually is. But in this case, you're even sharing with us outright that this should not be the all-in-one portfolio for somebody. It should complement the portfolio. How should we construct our portfolios with the Peerless ETF?
So I'll tell you how I do it personally. So I have over 10 years to when I'm planning on retiring or drawing any substantial money out. So I'm primarily equities. I might own 50%, 60% large cap, kind of like I said before with some of those other areas. And I own about 20% in this. And I run it, so I have a lot more confidence in it than maybe the typical investor, but I don't think I'm going to give up much, even in a normal 10-year market. I don't think I'm going to give up much, if any, return. But in a flat market or down market, I'm going to win with this. So contrast that with like T-bills or cash, right?
Sure.
I'm confident that this strategy will do better than the T-bills and cash. We can't guarantee it, but we'll do better than T-bills and cash, and could do better than SPY if we get a flat or kind of range-bound type market. So it's an income strategy. It came out at $20 a share. It's like 20.6 now, but we paid a 60-cent dividend. So it's made like 6% in 5 months. We try to get like 1 to 1.5% a month in option premium. But here's the thing, sort of to your point. When we get a bear market, those buffers, out of the money buffers, will slowly but surely get breached, and we'll eventually get to buy everything. And it will, at that point, resemble like a typical diversified long portfolio.
Sure.
And at that point, it's just as risky as like a SPY would be, right? You're not going to lose as much typically because those buffers will protect you against first loss, and we're getting that income to help offset. So we've analyzed it, and it tends to, the ETF only has a 5-month history, but that period of time we had a couple months ago when the Japanese yen carry trade kind of set off a bit of a panic, there was a 10% decline from peak to trough in the S&P over about a 3 or 4 week period, and wheel was down between like 4 and 5%. It depends on the speed of the decline. If it's a slow decline, we're going to reset every week, and we're going to might not lose anything. Quick decline, we'll miss the first little chunk, but then we'll be in it for the latter. So it's a niche strategy. My clients usually own 10% in it. It's not about me guessing where the ball's going to go. It's about having a player there in case it goes there. So we get a flat market, maybe that's right field. I want somebody there.
It comes down to really playing it safe. I mean, we can't predict the future, but we could try our best to play on the field wherever the ball may go.
And this whole PE, elevated PE thing could be a myth. Maybe we're in a time period where the modern era, PEs might be worth, justified to trade a little higher. Maybe earnings will grow because of efficiencies and productivity gains with AI. Maybe we'll get earnings grow, which basically means PE ratio comes down, right? More reasonable. Those could come true, but I don't think people should dismiss the fact that it's elevated right now. We've had 20% plus years. We may have pulled forward some gains, and for people that are new to investing, it's normally not this easy.
I was going to say, anybody, I feel like, got away with being an quote-unquote expert from 2020 to today because it has been that easy to invest.
I tell people, don't confuse brains with a bull market.
It's dangerous waters out there right now.
Yeah.
And I also feel like, though, for the last couple of years, I mean, we've been hearing words, whether it's recession, or the down market's on the way. I'm curious, what do you think is in our future? I mean, the election's right around the corner. We got interest rates slowly working their way down. What are some trends you're looking into, and what can we expect?
It's been remarkably unvolatile. I'm not used to it being this unvolatile. Very small swings. There seems to be a lot of confidence. Yes, interest rates have coming down. Inflation seems to be, relatively in check. I think it'll probably be something that we don't know about. That'll some sort of something that might spark a correction, because market, S&P, general markets, they will go up over time. That's just the nature of these things. But PE ratios do not go up over time. They eventually, kind of get down to a kind of revert to a mean. Now maybe it should be 18 instead of 16, but I don't know if it should be 23. So we have to either have prices go up or come down, or earnings go up. It might be a little bit of both, but it seems to be fairly calm right there. I'm surprised people aren't a little bit more concerned about the election. I think markets are smart enough to know that what these people are campaigning, these candidates are campaigning on, is unlikely to ever get past a lot of these things. Because Congress is split, it's likely to continue to be split. There's a higher chance it'll go all Republican than there's almost no chance it'll go all Democrat. And you kind of have to have all that, you have to have sweep Congress and president to get what they want done. So I think markets understand that there's probably outlandish promises are just not going to happen.
And looking forward into the future, I mean, are there any particular trends that you're seeing, at least right now, that are exciting for you and Peerless?
I think the main one that we are focused on is how just the trend of there's high valuations and higher interest rates. They're not sky high. A couple of years ago, when PEs were maybe 22, 21, interest rates were super low. And you can justify higher valuations on stocks if interest rates are low. The reason why is because the primary alternative to stocks is bonds. As rates get higher, I'll take it to an extreme level. Let's say I could buy a treasury bond paying 9%. Well, the long-term average of the market is 9, maybe 10. Why wouldn't I just buy a treasury and have a lot less risk? So the competition from stocks to bonds starts to go in bonds' favor. But we're not at the low interest rates anymore. So I think owning some out-of-favor sectors, whether it's small value or emerging markets, and tempering the expectations that you just can't own the Mag 7 and, just keep, take Ari's advice and buy some dividend names. And I'm not against, I don't like to market time, but if you want to market time, do it with new money, not existing money. Like, don't sell what you're in. But if you want to wait a little bit for a correction, I'm not totally against that. I mean, we're overdue.
Sure. It's almost like have some money on the sidelines.
Yeah. Pay down debt. Pay down debt. If you got an 8% car loan, you might think, well, I'm making 20% of the market. Why would I pay? You're not going to keep making 20%. Pay down the car loan.
I got a question for you when it comes to portfolio construction, because there's a lot of comments that I typically see on multiple, whether it's channels or even my videos, right, about portfolio construction, the size of a portfolio. How many ETFs should we have in there and individual stocks? Even if we wanted to add Peerless ETF in there, which is going to be, as you said, it's about 20%. I mean, how do we really construct this? Some people have, 70, 80 holdings. My thoughts are like, you might as well own the ETF. How do we construct it?
First off, you really have to be careful with some of these newer ETFs these days because they can get extremely specific and high risk. And there are double and triple levered ETFs, which I would stay away from. You can invest in, Chinese electric vehicle companies with one ETF, like very narrow sectors. There are even single stock ETFs, which make no sense to me in the world because exchange traded fund is like multiple diversified in my opinion. But there's even single stock ETFs, which are kind of ridiculous. They use option strategies, whatever. But I like the core being like that U.S. large cap. So there's, and that's just, you just go with the lowest fee one. You just, whether it's Schwab S&P 500, Vanguard S&P 500, because they all do the same thing. You might as well go with the lowest cost. And these things are virtually free these days, 2 basis points or whatever. I think VOO is the U.S. large cap. That's the base. Then, you can own a small cap ETF. You can own an emerging market ETF. You can own a real estate ETF. To me, when I set up client portfolios, that's how I do it. Then, if you like some names and you like being involved, and Ari's got some great stories, then build around that with those names. I don't think you need more than 10 or 15 names in a portfolio, individual stock names, to benefit from diversification. You get a ton of benefit. I've seen stats on this. You get a ton of benefit up to about like 12 or 13. Then adding more, you get very little extra benefit. So if you can, I'd much rather people understand and follow 10 names than throw money at 50 of them and just, you can't follow 50 stocks. Yeah. And one of the categories, when I look at like mutual fund managers and ETF managers, one of the factors in predicting if they're going to continue outperformance or of the S&P is they tend to concentrate a little bit more than the typical. Like a lot of these large cap fund managers will own 100 names, and it's like you're basically a closet index fund at that point that charges more. The ones that do typically better are the ones that might stick to like less than 50, and they have analysts and teams and all that. Like one individual, try to find like 10 or 12 good stories, and I would focus on those and add to those when they dip, and if you have to sell them, make sure that you're doing it. Don't do it knee jerk and take Ari's follow him on that.
Erik, you have the great privilege of putting together client portfolios Now, you shared that typically, 10, 14 stocks or holdings in there is sound. But I'm curious to know about some of the red flags that when you have that responsibility to put together these portfolios for clients, what red flags, if you see them pop up, do you run away from? And on the other side of that, what are some of the green flags that attract you to the companies that allow you to add them to client portfolios?
Well, first off, the biggest red flags that I want to maybe caution some viewers on is just some of the fear and greed stuff you see online. World's ending or double your money. I mean, and maybe this is a sign we're topping out at a bull market, but I keep seeing ads on CNBC. They're literally picking tickers and pumping them up. Okay, you've heard of pump and dump schemes, right? They are saying XYZ pharmaceutical company, ticker, blah, 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 has this new drug that's going to get FDA approved. That's the last place I'm going to invest. Back to your point, if it's too good, it should be true. When I structure client portfolios, I typically don't use individual stocks. And when I'm looking at the allocation, if I'm using an active manager, let's say it's for my real estate fund, if they have like 1 year that's maybe underperforming, that's not a reason to sell. But if it keeps going, or if they change their fund manager, back to my baseball analogy, if the shortstop has one error, you're not going to send him back to the minors. But if he continues not to and doesn't show up, I make very few changes. I will rebalance. Okay, so like I have my large cap exposure. If I'm not using S&P, I'll use like the Schwab Dividend Fund, SCHD, and then I'll use a growth fund, large cap growth. It's from the American Funds Group, Capital Group. They're one of the few that keeps their fees really down and they outperform. Those might be 20% each of the portfolio. Growth has been doing better than value and dividend. If I don't rebalance, the growth starts becoming more and more of a portfolio and it gets out of whack. If I rebalance, I'm selling what did well. And now if I just call a client, see, I have discretion on my accounts, but if I called a client, had to get their approval, and I say, hey, that thing that's doing really well in your account, I want you to own less of that. And this thing that's just really not doing well, I want you to own more of that. They'd be like, are you crazy, Erik? Frame it another way. Hey, this thing's been doing gangbusters. Let's take some profits and let's get in cheap before this other area starts to go up. And the effects of rebalancing over long periods of time have been shown to add like 50 basis points a year to returns. It doesn't work every year, right? Like two years in a row, growth has beat value. So it has not been good to rebalance. But over long periods of time, it typically works because you're kind of selling the frothy areas and putting it in the out of favor areas. And then you get the change of sentiment and it goes the other way.
I just got this comment the other day. I'm curious to get your take on it. An investor, a retail investor out there wrote, I'm 45 years old, just turned 45 years old, and I am just starting to invest. I have no idea where exactly I should look. I'm scared, but willing to start. How would you respond to that?
I would say, does your employer offer a 401k and is there matching? The odds of that are probably pretty high that there's a yes answer. Start there. If they match $6 for dollar on the first 6%, put 6% away. I like Roth a little better for someone that young because then you don't have to worry about what tax rates are in the future and you paid your taxes and it's all tax free. And then buy an S&P 500 fund. That'll work to build the base. And then do the same thing, but not in a 401k, right? Open up a Schwab account, a Fidelity account. It's very easy to do. When you're just starting, one of the problems with the advisor industry is we don't want to help people that don't have a lot of money because we charge 1% of the assets and we don't make anything. But there are advisors, and I do this too, that will, they'll charge a few $100s to sit down and help people do all that, just kind of a basis. But it's not that hard. You can open up an account, link it to your bank. VOO is really easy. You can buy shares of that, or like Schwab has a mutual fund, not an ETF. So mutual funds have 5 letters in the ticker. ETFs have 3, or sometimes 4. So mutual fund, it always ends in X. And you can dollar cost average into mutual funds. It's the same underlying securities. I would start there.
Now,
and get your debt paid down, other than your house.
The investor who's in their elder years, almost nearing retirement, because sometimes I get these comments.
Yeah.
And they're harder to respond to because you really have to be careful. Now you have fiduciary responsibility.
Yeah.
So I'm really curious about your take on this. When it comes to someone who literally is just turning maybe 55, 60 years
Yep.
old, is there still time for them to jump into the market? Should they be in the market? What would you recommend for them?
Well, so that's a lot. That's my typical demographic of my client base, near retirees, in retirement. If you have a nest egg saved and you're planning on drawing from that, don't put it all in equities, okay? Because you run the risk of what I call the reverse snowball effect. You start pulling money out, you get a couple of down years, you're still pulling money out and you're selling low. It's reverse dollar cost averaging. And it works when markets are going up. Have interest rates are higher, have 20% in bonds or like 10% in wheel. Have a little bit of protection. Don't spend more than 5% a year of your portfolio. If you want it to last forever, that's a good rule of thumb. So if you had $1 million, you can spend 50 grand a year and only give yourself a raise if the portfolio grew the previous year.
Sure.
Those simple rules of thumb. We have software, super fancy software that we charge for financial plans and all that. It basically says that, what I just said, 5% a year, have at least 20% in bonds. Now, to start, at that age, it gets tough because you just can't have compounding. You don't have the long-term compounding at your favor. So if someone's behind or they're just starting in their 50s, you probably are going to have to just work longer, and Social Security will continue to ratchet up all the way to age 70. So you may just have to, work till then so you can get a high Social Security check. And it may be better, depending on your debt situation. If you have any debt outside of your mortgage, you get all that cleaned up. But then it's the same investing. You just might want to add some bonds if you're going to, draw some off it soon.
Let's get this bird's eye view for the market, the investor, the retail investor out there. What do you think is the most common mistake that is perpetually made amongst us retailers?
I think it's giving into panic. And there was a study from Dalbar, and what they looked at is, I think it was over about a 20-year stretch, and they looked at the investments that clients owned and it was mutual funds. It was not individual stocks, but they were able to analyze the mutual funds the client owned, and they divided it. And what they did is they compared the investment's return to the investor return. Well, isn't that the same thing? No, because the investment return was something like 10 or 11% on average. The investor return was like 6. Why? They sell during a panic and they wait till things get better to buy back in. That line in and of itself says things are going to get better and I'm going to sell low and buy high. It's our money, emotions, we see loss, it's normal, very normal human behavior. But buying too much high and selling too much low, that by far is the investor's worst nightmare. If they're doing everything else right, buy the S&P, diversify, those things are, you could, and it never fails. Every election, I get a few phone calls from clients. I remember Obama got elected, and I had a few of my more vocal right of center clients that called and said, "Oh, we're going to hell in a handbasket. This is it. Sell me out." And we had a good 8 years with markets. I tell clients, you're buying companies, not politicians.
Sure.
And so one mistake like that, and you miss out on a 30 or 40% gain, kills your averages. So stay invested, buy quality, stay invested.
So every master of the market that I've had on always has an icon of some sort, an investor icon. You call your Warren Buffett, if you will. I'm curious to know who you look up to as an investor, an investment sage, what you've learned from them, and if you were to go out to a dinner or grab a beer with them, what type of questions would you ask?
Well, I think the easiest is Warren Buffett, because I mentioned him a couple of times. I think he has a really good knack for making the complex simple. And almost, he might oversimplify it because, he's 90s, whatever now. But that would, and he's used cash secured puts, which I just learned a few months ago. On top of that, I'd probably be more, just because of the stage I am, I'm really trying. Rob and I are really excited about this ETF. We want to grow it. Probably talking to some of the, CEOs of, of mutual fund ETF shops that have grown over the years, and kind of how they did it and how they got the word out would be maybe of more timely interest to me.
Sure. So my last question for you, Erik, it's an exciting one for me to always ask every master of the market who joins us on Masters of the Market. If I were to give you $10,000 right now to pick one stock, or I'll let you go in the ETF route as well.
Thank you.
Which ETF or stock would it be, and the why?
I would buy like a small cap value ETF. Let me make sure I got this right, but I think VB, as in Victor Billionaire. I think that's my phone here. VBR, Victor Billionaire Riddle. VB is just the small cap blend, which would be fine too. But I like the small cap value. That sector has done better than the S&P over long periods of time. But it's just so out of favor right now. I like buying the out of favor stuff, and I don't think enough people own that sector.
Sure, money to be made, and definitely investors. We have Erik Thompson on with us on Masters of the Market. Erik, I want to thank you for joining us. Of course, investors, the Peerless Wealth link and Peerless ETF link will be down there in the pinned comment and description. Definitely go head over to Peerless. Of course, Erik, it was an absolute pleasure to have you on. A lot of insights offered. Happy to have you back on at some point soon. But investors, until next time, we will see you all in the next one.